On the FMCG sector, ICICI Securities expects higher spending on welfare schemes, and these welfare schemes would likely drive faster private consumption. They also expect sustainability of recovery in rural demand as the tailwind for FY25. So to discuss this and more with us, we have back in our studio Manoj Menon, who is the Head of Research and FMCG expert at ICICI Securities. Manoj, thank you. Always a pleasure having you with us in the studio.
Thank you, Mangalam. Thank you, Ekta.
So, let's dive in immediately. Everyone is saying there will be perhaps some push coming in from the government, SOPs to boost consumption, etc. And you've also in your note written that not only is the street expecting that, but a large part of that is also priced in. Yeah. But over the last few trading sessions, people are believing that maybe policy continuity will come by. There will be more rational spends by the government to boost consumption. So, as a result of which we saw the stocks come off as well.
Right.
What are the expectations now?
Okay, let me take in two parts, as always, right? Because there's always both sides to the coin. The first part is actually that leave for a minute what happened in the last 1 month or couple of weeks, right? I mean, so if you go by the commentaries by most of the companies after the fourth quarter, company has been clearly calling out two aspects. One, the syndicated data, whether it's Nielsen, IMRB, Kantar panel, etc., is already showing some signs of rural recovery. Secondly, since companies have got visibility on outlet level revenue, they're also qualitatively committing that they're actually finding some green shoots, right? Majority of the companies, not all of it, right? So it appears that a rural recovery is absolutely on track. Okay. Now, what does it actually mean that even if valuations are punchy, let's say in line with the last 5 and 10 year average, the fact of the matter is that the expectations of an upgrades will remain for a fairly long period of time, right? Second point is that if you generally look at the ownership of FMCG stocks in particular, let's say versus discretionary, it appears it's under-owned, which essentially would mean that it will be a buy into dips sort of a situation rather than a sell into rally.
Okay. Well, just wanted your thoughts in terms of what the expectation is when it comes to the budget. And, what are you telling your clients when it comes to purchasing consumption stocks ahead of that? Do you think that it's probably going to be consumption friendly, consumption focused?
See, going by the expectations currently, it appears a fair probability that there will be a slew of announcements, etc. That said, we just don't have any concrete evidence to actually take a call this way, that way, right? I mean, just about the short term. Our take is that, if I look at FY25, let's say 12 months from today, let's say for the sector, price growth, let's say, didn't exist in FY24, right? That kind of is getting into the base. Point number 2, there are green shoots of volume recovery already happening. Point number 3, urban continues to perform well. So if I put plus valuations and expectations of upgrades, etc., essentially would mean that, the companies which in our opinion, which are doing self-help, right? What I mean is essentially that they have a strategy on their own and not just waiting for macros, which is a thesis for a fairly long period of time. They should continue to outperform because they have a strategy in place. On top of it, if there is a tailwind, it's a double engine sort of growth for them.
All right, so they're doing well, and if the environment does well, they'll only do better because they are already put in, levers for growth. So speaking about levers,
that's right.
Higher rural wage has high correlation with HUL's volume growth.
That's right.
What are you penciling in this year for HUL's volume growth? And do you think time now has come for one to look at this giant because it's underperformed for a very long time?
Good question. So we have done this analysis over the last 20 years, based on Reserve Bank data. So Reserve Bank publishes rural wage growth and rural consumer inflation, right? Now, essentially the gap is the actual purchasing power, right? If you actually plot this versus HUL volume growth, you actually find a correlation of almost 0.8, right? It's undisputable, right? If the expectation is of a rural affluence incrementally, it's a logical assertion to actually say that whether it's HUL, whether it's Dabur, whether it is Nestle, Marico, the whole host of companies, right, will actually get a tailwind. So I'll not really single out HUL here. Companies which has got a fairly high rural exposure, in conjunction with a good performing urban portfolio also, right, are the winners here.
Dabur is not in your top picks, why?
It's actually fairly punchy in terms of valuations. There is nothing really wrong in the strategy as such.
Okay. All right. If you had one key risk that you had to point out, going into the rest of this year, what would it be for consumption stocks? Which one do you think would probably even be more vulnerable?
I think unexpected inflation, right? Typically, consumer staple companies perform well when there is a certain predictability in terms of inflation, right? So that you can actually plan your budgets appropriately, right? Let's say Ukraine war happened, right? Suddenly there was a significant inflation. Companies were forced to take price increases to somewhat protect margins. And consumer incomes are not growing in line with the inflation, right? So which in that sense, kind of down trading, etc., all those issues actually happen. So if there is an unexpected crude inflation basket sort of a scenario, I think the sector kind of would struggle.
But the probability of that happening is quite less.
That's that's a toss of a coin call, right? So you never know. We're talking about a commodity, right?
Just from an upside from current levels, what is it that you see on stocks, and where do you see the maximum upside? Because, okay, if things improve and all of that and stuff, stocks are trading at punchy valuations as compared to their averages.
Yeah.
Where do you get that alpha? Is it likely to, just be a little over what the Nifty is doing, or how much more scope for outperformance is there?
So I'll put again consumer staples into two baskets here. Let's say companies like Marico, which are trading at acceptable valuations, where there is the D2C execution aspect, there is a distribution expansion which they are implementing. So the potential for upgrades, let's say in a company like Marico, is very high. Earnings upgrades, that's point number one. Or there are companies like Jyoti Labs, right, where the visibility of let's say distribution expansion, market share gains is very high. The valuations at around 30-32 P is absolutely acceptable, right? The second basket is company like Godrej Consumer, Tata Consumer, which we spoke last time as well, where valuations are punchy. But the predictability for the next 12-24 months is so high that you can expect earnings rollover-led stock performance.
Okay. I can't see Titan on your list. If you could just give us a sense in terms of what your approach is towards Titan.
Yeah.
And you also like Kalyan Jewellers.
The thoughts are same actually for a very long period of time. Look, we are downgraded Titan some time back, and the thought process actually has been that two aspects has happened in the market currently. One, there has been a higher acceptability of newer brands from a consumer point of view.
Yes.
Tanishq is not the only choice for the consumer at a pan-India level. Point number two, there is also availability of capital for most of the regional jewelers also. And point number three, hallmarking has essentially increased awareness from a consumer point of view, saying that I can trust multiple, otherwise you would have, let's say, not so be comfortable sort of brands as well, right? Now, Kalyan specifically is a classic case of being in the investment for a very long period of time, and they're just getting the benefits of the earlier over-indexed investments in terms of brand awareness, visibility, etc. Lastly, on Kalyan, one trivia about the Kalyan is that, I'm not sure how many consumers actually realize that it's actually a brand from Kerala, because the brand, the word Kalyan, essentially stands for goodness, etc., in almost all Indian languages, right? See, from a consumer perception point of view, if you have to walk into a jewelry store, you need to believe that it's either your regional sort of an affiliation, or you have to believe that it's a pan-India brand, right? I think the name also kind of helps. Apart from the other good execution what they've been doing.
I'm not sure that was the only reason.
Apart from multiple reasons,
because of the founder, Mr. Kalyan Rama, as well. But just to wrap this discussion up, retail. Eventually, if you're looking at consumers going ahead and increasing their purchases, they would have to purchase it via retail. So where do you stand on that? Value retail. What are your thoughts? Which ones do you like? And then quick commerce. That's suddenly blown up as a channel.
Yeah. Look, I think we do believe that there is an intersection of value and convenience, right? Now, obviously, quick commerce is performing well, but I do believe that there will be a point in time, 12-24 months hence, right? I mean, kind of quick commerce will have to find newer avenues of growth, because it's actually over-indexed on convenience and not necessarily on value. And India, relatively being a poorer country, DMart is probably the only value retailer at scale. I'm not talking about VMart, which is an apparel retailer. I'm talking about the larger, retail, right? So we continue to like DMart. I think a lot of the perceived disruption from quick commerce is already there in the price.
With the growth in Zudio and now possibly Star, would you think of Trent as a value retailer as well?
Trent, business is value. I'm not sure about the stock.
Okay. Well, before we let you go, just a question in terms of the one stock which you would recommend as a buy across the sectors within the FMCG space, and the one top sell that you probably have in this year.
Okay, so without looking at market caps, right? So we continue to back Jyoti Labs on the consumer staple side. We do find that Zydus Wellness is likely to turn around, etc. So that's another aspect which has been a forgotten stock for a fairly long period of time, right? I think they're getting the execution right, and it's been a great summer, etc. Right? So that's on the staple side. Large caps, again, it's Marico, Godrej, the boring names, Tata Consumer, etc. Right? I mean, it's nothing new. Outside of that, we have a reduced rating on Asian Paints, and it's been a high conviction for a fairly long period of time. And as each day passes by, which we do believe that downsides actually is higher, and as Grasim continues to execute over the next 12 months.
What have you found out on the ground with regards to the early acceptability of Grasim's product?
It's too early. Let's say, for example, I was in Chennai last week and I just found a lot of hoardings of Birla Opus. So I think the context to note here is that they have put up the capacity, but the front-end brand building, let's say supply has been created, but the demand side is yet to happen. But when we talk to dealers, etc., we do find that there is a reasonable amount of acceptance, in let's say nation-dominated markets, etc., of the willingness to actually try out a newer brand at a dealer level as of today.
But smaller paid companies, would you be incrementally more negative on them?
So we have a thought process that which we have been publishing over the last 6 months, saying that for any contrarian investor, right, from a game theory point of view, if you really believe, let's say you can have a point of view saying that, let's say Grasim may not succeed. We don't have that view. I'm just saying you can have that view, right? If you have that view, you're better off playing the paint sector by actually having a positive stance on the smaller names, which is Axo, Indigo, and Kansai, for a variety of reasons. Point number one, these companies, let's say Axo and Kansai Nerolac, has got a higher exposure to non-decorative, automotive and industrial, where it is business as usual, right? Second point is that, let's say an Axo Nobel is a premium company, right? It's very unlikely that a premium player, consumers' stickiness is low. It will be fairly high, right? And Indigo has been executing well, actually.
So, since we have you with us and since it's time for a meal as well, what are your thoughts on F&B space and QSRs? And then there's liquor as well, where there is still some policy clarity awaited?
Yeah. I wouldn't really put Nestle. I heard you speaking about it a little earlier, as an F&B play, right? Because it's just about probably...
That was CLSA's call, not
No, I'm just, sorry, it's not about that. So what I'm just saying is that, look, Nestle, probably about 1/6 of their revenues and profits come from, let's say, F&B, right? It's really not an F&B play, right? So Varun Beverages, for example, squarely is, right? I mean, so probably Varun Beverages is a better option out there. Other than that, look, QSR, we are finding at least things bottoming out, right? And lastly, on Jubilant, the strong conviction that the delivery fee waiver by Domino's, in our view, is a potential upgrade opportunity, because it's a unique situation where they are the only brand which can actually offer you delivery waiver because they have their fleet and they have their app, etc. So to that extent, they're not that reliant on the aggregators, right? It's a certainly competitive advantage, and I think it's a J-curve sort of recovery we expect in Jubilant.
We heard that from Sameer Khetarpal when we spoke with him. He said that the delivery cost waiver has actually led to good growth in not only the fourth quarter, which we know about, but first quarter as well. India-Pakistan game, he said that, a lot of pizzas were sold at that time, and they've opened, 2,000 stores now on the Domino's front.
That's right.
Okay,
That's right.
All right, Manoj. But on that note, it's been a pleasure as always. Thanks very much for joining in and speaking with us. I'm sure we're going to touch base with you as we move closer towards the budget and post-budget as well. Thanks very much.
Thank you.
Well, before we take a short